The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. President Trump says peace talks with Iran could restart in Pakistan within the coming days. Well, Pakistan's finance minister telling CNBC at the IMF spring meetings that he's hopeful of a way forward.
We have to be hopeful because dialogue and diplomacy is the way forward, right? Because even as a country which is not directly involved in the war, but we are in a war-like situation.
The IMF, though, cutting its global growth forecast, warning the Iran war leaves three bleak scenarios: weaker, worse, or severe. The chief economist, Pierre-Olivier Gourinchas, telling CNBC even the best-case outcome represents a major downward revision.
Even under the most benign scenario that we have, our reference forecast, we expect growth to be 3.1% this year. So it's a 0.3 percentage point downward revision relative to where we were somewhere around mid-February. It's a very significant downgrade.
A chipper earnings update from ASML, which hikes its sales outlook for the year to as much as 40 billion euros amid stronger AI demand. Kering narrowly misses on first quarter revenue, hit by weaker Gucci sales as the Middle East conflict weighs on demand. But the luxury giant says it's a first step on its road to recovery. So the US President Donald Trump has suggested the possibility of further peace talks with Iran, telling the New York Post on Tuesday that something could be happening over the next 2 days in Pakistan. Meanwhile, in a separate interview, Trump told Fox Business he believes the war is almost over and that Iran wants a deal very badly, but also suggested that Washington is not finished. The president also told ABC that he's not thinking about extending the ceasefire with Iran as he doesn't believe it'll be necessary, saying, "I think you're going to be watching an amazing 2 days ahead." Speaking to CNBC at the IMF World Bank meetings in Washington, Pakistan's finance minister gave his take on negotiations.
We have to be hopeful because dialogue and diplomacy is the way forward, right? Because even as a country which is not directly involved in the war, but we are in a war-like situation. And I can tell you as a finance minister, the first order impact that we see in our country in terms of the molecule availability, the pricing, the price transmission, and then the second order impact if there is longevity in this and the duration goes forward and the intensity goes forward, the second and the third order impact would be quite a big issue for the entire world, but certainly for us as well.
Well, Dan joins us now with the latest. Dan, just bring us up to speed with the sense around these latest updates from the president where you are.
Ben, good morning to you. Well, as you've been discussing, oil and equity markets certainly pricing in a growing chance of a breakthrough now, as President Trump says the war with Iran is, in his words, very close to over. A White House official has confirmed to CNBC that a second round of US-Iran talks is now being considered. President Trump also telling the New York Post, as you mentioned, that the negotiations could take place in Islamabad within the next 2 days. So there is momentum building towards what could be another peace summit between the United States and Iran, and it is likely this time round that we could potentially see the ceasefire being extended, in effect buying both sides more time to come up with a concrete deal. And then at the same time, on the water, the US Navy blockade of all Iranian ports is now in full effect. Actually, the CENTCOM commander, Admiral Brad Cooper, said that in less than 36 hours, US forces have been able to completely halt all economic trade going into and out of Iran by the sea. This is a huge development here. They say several vessels have already been turned back when instructed, and this has all taken place without the US conducting any strikes or tanker seizures, at least that have been reported. And that is very significant. It's also very good news, and it shows that the ceasefire is in effect still holding. But of course, the strait itself remains largely paralyzed. Goldman Sachs also out with a note in the last 12 hours saying flows through Hormuz are running at just 10% of normal levels. That is roughly 2.1 million barrels per day on a 4-day moving average. So still not really a lot of movement in that critical waterway, which is why we are still seeing this price elevation for oil despite the ceasefire and despite the diplomatic off-ramp headlines that we're now following that have also helped to pull oil back towards $90 a barrel. What was interesting as well was that the IEA in its report that was published this week was also pretty clear, saying that resuming flows through the strait is the single most important variable in easing the pressure on energy supplies, on energy prices, and of course the global economy as well. It's something the IMF also referenced in its global growth downgrade overnight. So as it stands right now, the blockade is biting, the strait is barely moving. This ceasefire, of course, expires in around 8 days from now, but for the first time since the conflict began, both sides do appear to be leaning towards a deal, and it seems as if markets, at least in oil right now, are betting that they might mean it. With that, it's back over to you.
Yeah, Dan, this isn't what the US promised originally when they started this campaign. The US promised that they would have, when they realized that the Strait of Hormuz was becoming an economic weapon, that they would be able to open up the Strait of Hormuz. Now, whilst I appreciate what they're doing with the Iranian product as well, what I really want to know is any GCC product getting out as well, because it seems clearly that despite the fact that some ships, as you mentioned there, are getting through, we're not seeing oil, fertilizers, LNG and other key global commodities flowing out from the GCC countries, albeit with the US blockade focused on the Iranian coast.
You're exactly right, Steve, and this is something that you and I were talking about yesterday. I think this is so important to bring up. Saudi Arabia has effectively been able to bypass Hormuz by sending oil across the desert through the east-west pipeline to the port of Yanbu. And you'll recall that the Wall Street Journal reported yesterday that the Saudis are pushing for the US to end this blockade inside Hormuz as quickly as possible, because they were concerned that perhaps any Iranian retaliation could perhaps happen inside the Bab el-Mandeb Strait, which they've been relying on to get crude to their customers. So it is pretty clear that the Gulf perspective on this is one of optimism, but also one of caution, right? Of course, they've had to shut in production onshore here and offshore as well, because the oil they're producing simply has nowhere to go. And then on the diplomatic front as well, I think the UAE perspective on this has been quite sound and perhaps the most interesting Gulf country to watch. The UAE previously saying that it would be open to this idea of supporting any American-led effort to reopen Hormuz, but exactly what that looks like in practice and the legal framework that would support that is a big question mark at this point too. So the Gulf countries clearly want Hormuz reopened. You saw the IMF warning suggesting that this could have a really significant impact on the Middle East region in particular, not just the global economy. So the economic stakes here are really high. They want that oil flowing again, but at the same time, they also don't want to leave the region in a more dangerous situation than when it started as well, because the message that we've been hearing, the voices that we've been hearing from these countries is that they want to ensure that Iran has essentially been cut back enough, throttled back enough that it can no longer pose a threat to their economic interests, their civilians or their civilian infrastructure. And I think that is probably the most important question now. At what point will the United States actually exit this war, and in what state will Iran be in? Will it be appropriate for the Gulf states to deal with moving forward at a military level, at a diplomatic level, at an economic level? I think that remains to be seen.
Yeah, Dan, and look, you, of course, know at length, and we've talked a bit about how painstakingly long the process has been for the UAE and other GCC countries to make themselves look like safe havens, make themselves look like tax havens, make them look like incredibly desirable places to live for global diasporas as well. How much damage do you think has been done? I mean, and you mentioned the IMF comment, and obviously that is plain for all to see, but how much of confidence has been dented in that longer-term growth story that has built up over the last decade and a half plus, and now perhaps appears challenged?
Good question. I think the IMF report shows one thing on paper. What's happening on the ground here in practice is a little different, at least for now. Just anecdotally, I've had friends and also colleagues who have been returning back to the region, having departed when the war began. I'm looking around behind me here in Abu Dhabi. I can hear construction sites hammering away. There's boats that have been moving on the water here. People are busy getting back to work, and you really do get the sense that this is a country that has taken this war in its stride, not only being very effective in repelling those Iranian attacks, but also now working in overtime to get the country moving again, to get the economy open and to get back to business. And that's exactly what's happening here. As for the other Gulf states, it is a similar state of play in the likes of Saudi Arabia and Qatar, according to reports. You do get the sense that while there has been this short-term hit to the economy, the long-term resilience of these economies is not necessarily being questioned at this point. At the same time as well, the investability of the Gulf states is also something that we've spoken about and something that has been raised as a concern moving forward. We're already starting to see deals eventuate, and I think you only have to look at some of the activity from the sovereign wealth funds in the region to get a good gauge and a good sense of what we can expect when the ceasefire is in full effect, when the war eventually comes to an end, that this is a region that will be very keen to rebuild, and not just rebuild, Steve, but also build back better and build back stronger from the high baseline that it was coming off. So yes, the impact is real short term, but long term, fears are really easing that this is going to have a material impact on the investability of these countries, their attractiveness for international talent, and of course their homegrown economies as well.
Good, that's good to hear, Dan. Thank you very much indeed for all of your coverage as ever. Thank you, sir. All right, Ben.
Right, let's see how all of this is playing out on the markets. And let's show you the performance of Wall Street in the Tuesday session, because it was a strong showing for all of the major averages. It was the Nasdaq leading the way, up almost 2% by the end of Tuesday. The S&P 500 up almost 1.25%. The Dow slightly lagging behind those, but still up a generous 0.2%. But look closely at the S&P 500 figure, the closing figure, 6967. That not only has wiped out all the losses since the beginning of the Iran war, it is now just 35 points off the all-time high that it hit at the end of January, which was 7,002. So watch that figure closely once trading gets underway in the US. It could well creep higher, given these talks of the potential for further negotiations between the US and Iran. Looking in another region, let's see the picture on Asian markets, and you can see the positive sentiment being reflected there on all the major regional benchmarks. The Kospi, the one that's seen probably the sharpest moves during the recent weeks of volatility, is leading the way higher, up more than 2.25%. The Nikkei also adding value this morning, up 0.5%. The Hang Seng and the Shanghai Composite also trading up. Let's see what the anticipated open is when trading gets underway here in Europe in just over 45 minutes from now. And, well, a slightly mixed picture being called there by the futures. The FTSE looking to open just above the flat line, but the Stocks 50, the European-wide index, the blue chip, and the DAX looking to give up territory. But, of course, anything could change in the next 45 minutes. We'll bring you the market open when that happens, of course, here on Squawk Box Europe, as usual. But mentioned the US performance yesterday. What's likely to happen or what's being expected? Again, bit of a mixed picture there. No big shakes, just hovering around the flat line. But, again, several hours off the market open on Wall Street. We'll keep an eye on that for you. Steve.
The International Monetary Fund has cut its growth outlook for the year, now seeing 3.1% global GDP growth versus 3.3% that it saw in January, amid energy price spikes driven by the US-Israeli war on Iran. Well, due to the uncertainty around the war, the IMF presented three growth pictures: weaker, worse and severe, with the worst-case scenario seeing growth at 2% inflation at nearly 6%, and the average oil price at $110 a barrel. The worst hit developed economy, the UK, which has had this year's growth outlook slashed by half a percentage point to 0.8%. That's the lowest of all the G7 nations and around a third of the growth that America is expected to see this year. Karen asked the IMF chief economist Pierre-Olivier Gourinchas how global growth has suffered amid the war.
We went into this and there was a lot of momentum we could see in the global economy. I mean, it came out of 2025, of course, lots of disruptions, the tariffs, the trade policy uncertainty, that was weighing down. But then there were these other powerful forces, agility of the private sector, easy financial conditions, the tech, AI boom, all of these things, fiscal support in some countries, Germany, China, the US. So we were looking at the global economy in January, February. We're looking to upgrade. We're expecting maybe growth to be around 3.4%. Then the war happens. And now, well, we have a number of scenarios, but even under the most benign scenario that we have, our reference forecast, we expect growth to be 3.1% this year. So it's a 0.3 percentage point downward revision relative to where we were somewhere around mid-February. It's a very significant downgrade.
The investment banks themselves are running multiple scenarios too, and I thought it was fascinating that even with your extensive forecasting staff, the fog of war is making it incredibly difficult to forecast. You have this reference rate. I gather it is the optimistic scenario that the conflict gets solved soon. What if it doesn't? What is the worst case scenario?
Well, the shock, the war, creates a negative supply shock. Energy prices going up, like we've seen in the 70s, like we've seen in 2022. And this negative supply shock, it's reducing activity and it's increasing inflation. That's what we're going to have. Even under the best assumptions, we're going to see lower growth, more inflation. Then, of course, the size of the shock and the duration will impact the global economy. So in our adverse and our severe scenario, we're looking at more disruption. What if it doesn't get solved quickly? What if it goes and extends into next year? But then on top of that, we start thinking about what other things could happen that would also hurt the global economy if we're in that world. And there are two things that could happen. One is that, if we start seeing very high energy prices, people will start thinking about where inflation might go. So inflation expectations might, what we call de-anchor. We might see households and firms trying to increase wages or prices, and that will take us into a whole different situation. Then there's another layer coming from financial conditions. The markets so far have been absorbing this and taking it in stride. There's been a little bit of tightening, but not so much. But if it gets worse, there could be a significant tightening of financial conditions. You put all of this together, we get to our severe scenario, then growth this year and next is only 2%, and inflation reaches about 6% globally. Now, to give you a point of reference, 2% global growth is a very low number. It's a number we only had 4 times since 1980, and 2 of these times were times of very severe crisis, the global financial crisis and the COVID-19 crisis. So this is not a situation that anyone would like.
What's your message to central banks confronted with a supply shock?
Well, the message is very clear. It's a supply shock, negative supply shock. Central banks, there's not anything they can do about oil prices. This is set in the Gulf. This is the result of the conflict. Raising interest rates or cutting them is not going to change that fact. So to some extent, they can see through, but only as long as inflation expectations remain well anchored and there is no wage price spirals that takes over. So central banks can afford to basically wait, assess the situation, but if there is any risk that inflation is broadening, it's becoming more persistent, people start internalizing that there will be more inflation longer, then they will have to step in and will have to step in decisively.
I didn't do quicker than I thought. I'm eating a banana.
Thank
you for that, director. Right, it's all right. I've swallowed. So, thank you, director. It's lovely to have you back, Rod. I won't name names. I just did. Are you aware? Ruined my big sketch. Are you aware of the very sophisticated game called pinning the tail on the donkey?
Yes.
Of course you are. I'm sure you play it every weekend, where you blindfold the individual, you turn them around many times to disorientate them, you hand them a tail with a pin in it, and you try to get them to pin it on the donkey. That is what everyone is playing at the moment. And with respect to the IMF, You don't know any more than we do. And with respect to the IMF, your worst case scenario is nowhere near the worst case scenario. I hate to say it, but if in your worst case scenario, and I'll just reread there as well as I get the banana out of my teeth, with the worst case scenario, seeing growth at 2%, okay, I understand that. Inflation at nearly 6%, again, well, that may well be, okay. And an average oil price at $110 a barrel. That's not the worst case scenario. I hate to point out that if we see a global impasse on oil, on fertilizer, on LNG, on all other products coming out of the Middle East, there isn't an alternative for those 20 million barrels a day, or that 20% of production as well. And if the spot price has told us anything, and these prices are great, I mean, fantastic, we use them all the time. Brent, $94.8. WTI, 90.63. They're really useful, but they're not as useful as the fact that some people are paying $135 to get their oil now. They're paying $145 to get their oil now because the actual spot price isn't the future price. That is saying that in June, we think the price is going to be $94.80. In May, we think it's going to be $90. It is not the price being paid today. So with respect to the amazingly smart people at the IMF and at the World Bank and in Washington, they are pinning the tail on the donkey. We all are, until we know how long this is going to last.
You say that their worst case scenario is nowhere near the worst case scenario. At the opposite end of the scale, you've got the US Treasury Secretary, Scott Bessent, saying the IMF's overreacted. Saying that actually...
Overreacted to 20 million barrels a day of oil not getting to markets, to global energy prices going up, to diesel prices in the United States going through the roof, to gasoline prices in the United States going through the roof. We've overreacted?
Well, that's what he's saying. He's saying that the cuts to the global growth forecasts are an overreaction.
Does Scott Bessent know that we're going to open the Straits of Hormuz tomorrow?
Well,
no.
As you say, no one knows. And that is the problem. But it's there's this the fear around the how it's going to affect inflation. He is clearly leaning towards the desire for interest rate cuts, if not saying it explicitly. But I think that is reading between the lines.
Interest rate cuts? How can we have interest rate cuts when...
Gone 3.3% in March. I know. CPI, US inflation, 3.3% in March. And when the markets are performing so strongly...
The average price of a gallon of gas is now $4.20. It is up 93%. Beg your pardon, 93 cents from a year ago. The average price of a gallon of diesel in the United States is $5.65. It's up dramatically. It's up $2.07 from a year ago. And Scott Bessent knows we should have rate cuts? This man is a genius.
Well, I mean, I always try and put the opposite side, don't I?
I know you will.
Sometimes...
And you give me the opportunity to get the rest of the banana.
Yeah. But I think, it is really interesting. But the other stuff from the IMF was the imbalance of how it's going to hit different economies, and the UK has been highlighted as one of the ones in the G7 that's going to be the hardest hit. I haven't got the exact figures for what they've done for the downgrade, but they think the Iran war will have a bigger impact on the UK than others. The UK economy now forecast to grow just 0.8%, down from its previous projection of 1.3%. So the imbalance there. But again, I suppose they're looking at the different factors, the reliance on imported oil and gas. But as you say, anything could change within the next week, and those forecasts, I sometimes wonder, by the time the forecasts are written and printed, are they already out of date? Who's to say?
Can I say, with respect to the IMF, and I have a lot of respect for that august institution and Karen's brilliant interviews with Pierre-Olivier Gourinchas, there was another Olivier, a guy Blanchard. Yeah, do you know him? Olivier Blanchard. He was also a chief economist at the IMF, and he also was very downbeat on the UK. And I'm not here to be jingoistic, but they get it wrong sometimes. Moving on.
Yeah, I'm going to move on just because that was quite an interesting angle we had. My best side, I think. Still to come on the show. ASML lifts its guidance as the CEO says demand for chips is outpacing supply. Arjun will join us with more. Plus, the luxury check continues. Hermes and Kering posting results. Charlotte will have all the details. And we'll discuss data centres and clean tech with Veolia CEO Estelle Blachlianov. That interview coming up at 8:30 London time.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts. Welcome back. I got that cue. Chip equipment maker ASML has topped first quarter sales expectations and also raised its full year outlook. Europe's most valuable listed company. Wow, it's Europe's most valuable listed company. I didn't even know that. Now expects 2026 net sales of between 36 and 40 billion euros. Arjun, how are you, my friend?
Very well, thanks.
Good. Tell us all about it.
So very interesting quarter because we had this big raise in guidance for revenue. What's underpinning that it really is this continued demand for chips related to artificial intelligence across the board. And we know there's chip shortages across the board, most acute in the memory sector at this point in time. And chip makers are looking to ramp up their capacity and production. The likes of Samsung, SK Hynix, TSMC, etc. Of course, to do that, they need ASML machines in order to manufacture these chips. And it's interesting when we look at the breakdown of ASML sales, it shows us where that demand is coming from. So 51% of net sales in the first quarter really were going towards memory. Versus 30% in the quarter before. In South Korea, accounted for 45% of those sales versus 22% in the quarter before, and Taiwan was 23%. So you can read that through to mean Samsung, SK Hynix, and TSMC pretty much driving a lot of this demand as well. On China, we know ASML's most advanced machines have been restricted for a number of years from being sold to China. At this point, there are proposals now going through the US legislative system to mean even ASML's older machines may get export restrictions. China sales accounted for just 19% now of total sales in the first quarter, down from 36%. There wasn't any further commentary as of yet on the impact of China, but that really is the breakdown. It's being driven by those big chip manufacturers trying to ramp up capacity to meet this demand for these AI chips.
And just... So their involvement is with the machines that actually print the chips, is that right? That's why they're in such demand. Do they have any obvious competitors or rivals in that space? Or
Short
not?
answer, no. ASML makes these extreme ultraviolet lithography machines, EUV, which are the most advanced printing machines effectively on the planet. They are necessary to create the most advanced chips when we start talking about things like 7 nanometer, 5 nanometer. These are the number of transistors you can fit on a silicon wafer. And effectively, that number is getting lower and lower. And to get these, pack more transistors on these chips, these lower process nodes, as they call them, you need these EUV machines. ASML really right now is the only company that can produce these, and why there is such significant demand at this point.